Now, from the great economic reformer to some reforms in the pipeline, fund manager Roger Montgomery has been taking a closer look at what might emerge with David Murray's financial systems inquiry next month. And he joins me now. Roger, welcome.
Thank you, Ticky.
Well, let's go. The banks must be sort of slightly sweating it at the moment because
Yes.
I suppose it's all about the too big to fail, these DSIBs.
Well, that's exactly right. It's all about how much the banks are allowed or should be allowed to leverage their balance sheets. And so this DSIB or systematically or systemically important banks, how much capital are they required? And there's one view that David Murray will just shore up the banking system once and for all and require an additional 100 or 200 basis points of capital.
That's a percent.
Correct.
Or 2%.
Yes, it's a big amount of money.
Now, what does that mean in terms of what the banks might have to do to get that position?
Well, in the first instance, they would have to raise capital, and that would mean that they'd come to market and raise more equity capital. It's as simple as that. That generally isn't a positive for their share prices, by the way. That tends to be a negative for their share prices. But ultimately, it won't be the shareholders who pay.
Ah, right. So how are they going to pay for it?
Well, I think consumers will pay for it, and they'll pay for it with lower term deposit rates. So TDs will come down, and that's how they'll offset the greater capital requirement. And
what is that likely to do overall to the share price of these banks, do you think, if it happens?
Look, I think it'll put pressure on the share price. Now, whether or not that offsets an already rallying share price or it compounds an already declining share price, that's speculation, we don't know. But the net effect would be negative on their share prices.
There has been a bit of a ding-dong there about exactly where these banks sit globally in terms of their capital positions. And they were a bit dark on how David Murray assessed them in the sort of middle range, weren't they?
Yes, well, I think what he's doing is he's paving the ground or putting in the groundwork to say, look, you need to be expecting these changes. But that's only one of the changes. There is another change which relates to mortgage risk weightings.
Now, what do we mean by that?
OK, so what happens is for every dollar that is loaned out, or what you do is you take the amount of the loan, multiply it by a mortgage risk weighting, and multiply it by what's called the Set 1 ratio or the Common Equity Tier 1 ratio. Out comes the amount of equity or capital that you're required to have for every dollar that you loan. And the problem has been...
So essentially that gives you a sort of buffer when you're lending in the mortgage market as a financial institution.
But as David Murray pointed out, there's a real disparity or an unlevel or uneven playing field and an unfair advantage given to the big banks over the regional banks. And what do I mean by that? Well, for every $100 that is lent out by the big banks, they only require about $1.60 of capital. For the regional banks, for every $100 they loan out, they require $3.50. So David Murray has already indicated that this is unfair.
And well, of course, all the smaller financial institutions have actually been champing at the bit, saying, please do something about this.
Yes, and particularly some of the regional banks have actually been working with APRA to become advanced banks themselves. So this will even up the playing field a little bit, and there could be some potential opportunities for investors in those regional banks.
Now, how are they going to even it up? Are they going to make it easier for the big banks or... easier for the smaller banks or harder for the bigger banks?
Well, I think APRA's been right in anticipating this change. In fact, in APRA's own submission to the FSI, the Financial System Inquiry, they've actually suggested that rather than lower the requirements for regional banks, what should be implemented is an increase in the requirement for the majors. So you imagine there's 100 or 200 basis points of additional capital, and then their risk weightings have to go up as well.
Gosh, so it could be actually a double whammy. I mean, what are the risks to these sorts of changes?
Well, look, we've analysed this and we've looked at all the changes, and we think what comes out of all these changes is an opportunity to buy some of the regional banks.
But what happens if we get a macro-prudential action from the Reserve Bank on top of it all?
This is all separate to APRA and the RBA's moves on the macro-prudential front.
Right.
That's to try and tame the housing market while at the same time garner strength in our economy by keeping rates low.
So let's hope it all doesn't happen at once. Roger Montgomery,
It might.
Thank you very much for joining us.
Welcome.